Hi, good afternoon, everyone. I'm, honored and very happy to have, Jay Pelosky here with us. This is the first of a series. We're going to have bi-weekly, sorry, musings with Jay, where we're going to talk about, the state of the markets and, whatever is most important in global markets, which, at the end of the day is what drives markets in Brazil. So I'm going to hand over to Jay now. This is going to be a very informal conversation, and in a few minutes, I'll give him a chance to talk about his new venture, TPW Advisory, and especially describe the GRN, which is the risk methodology he uses, and and the factors it encompasses. So now, over to you, Jay, and thanks again.
Okay, thank you, Roberto, and hello to everyone. Very excited to be joining the OhmResearch network. One of my first jobs in the investment business was to start a Brazil fund back when I was at Morgan Stanley Asset Management way back in the early 1990s. So it's kind of fun to go full circle from those days to today and joining OhmResearch, which is introducing a new way to approach research and markets in Brazil. So very happy to be joining the platform. I do a regular Friday musings, as Roberto mentioned, and that's going to be kind of the thrust of these bi-weekly conversations we're going to have together with you. Basically, it's meant to be kind of the things that stick out most in my mind over the week, almost a distillation of key thoughts boiled down in terms of the actual musings product, which will soon be up on the Ohm site, roughly 500 words or a 2-minute read, which then allows us to talk about other things more deeply as we go forward. So excited to be starting that musings process with Ohm today. And as Roberto noted, I've launched also just today a new venture called TPW Advisory. And TPW stands for Tripolar World, which we'll get into in a minute. But the advisory business I'm launching, which I am the founder and actually the sole proprietor, is meant to be an independent research boutique providing differentiated and actionable investment advisory services to clients both in the US and abroad, both individual and institutional. And we intend to be a differentiated source of information and advice with a focus on forward-looking thematic work. I'm a big believer that thematic analysis and thematic investing is going to be what generates alpha in the coming years, driven by activist governments and policy-driven markets, which is an ideal setup, first of all, for someone who's a global macro kind of thinker and investor like myself, and then secondly, for folks who focus on ETFs as the instrument to implement these actionable ideas as I do. And I have almost 20 years of investment experience using my own capital in the ETF space. So really, I'm excited to launch TPW Advisory. I think it's an opportune time to focus on the non-US markets for Brazilian investors, to focus not only on Brazil, but look abroad as regulation changes. And so a global multi-asset, independent, original, actionable investment advisory service, not only portfolio strategy and asset allocation advice, but also white label research, and kind of most excitingly from my point of view, model portfolio delivery, which will be based off of ETFs that trade in the United States. So that's somewhat of a long-winded introduction to TPW, but maybe I can switch gears a little bit and talk about that global risk nexus, Roberto, that you mentioned a minute ago. So one of the things that I think differentiates my work and my approach to the markets are two building blocks that are proprietary to my work, original to me. The first is the tripolar world, which is a thesis I've been developing over the last decade. You can find out much more about it at my new website, www.pelosky.com. But effectively, it says that the way forward for the global economy is through regional integration, regional deepening in the three main regions of Europe, Asia, and the Americas. So that's my tripolar world thesis. Again, I've written about it, talked about it for a decade. Everything I see happening today, the fight between the US and China, Europe trying to carve its own path, Brexit, President Trump, nationalism, all these things flow out of a tripolar world point of view. And so I feel very strongly that that gives me a differentiated approach, a proprietary approach to the global markets. And then underneath that is this global risk nexus that Roberto mentioned. Here, I look at economics, well, actually health, first health. We added a health component back in the spring of last year with COVID. We look at health, economics, policy, politics, and markets in the three main regions of Europe, Asia, and the Americas, as well as globally. And so this allows us to have structure, to put structure around a global multi-asset point of view, which increasingly in today's world, with governments being more active, lots of political volatility, central banks on the move, health issues coming to the fore, climate, etc. It's really critical to have a framework and a process that allows one to keep all of this kind of coherent and together in one's mind and be able to contextualize the different bits of news and information that kind of come out at you like a fire hose over the last couple of years. And so the global risk nexus does that for us and has been very, very beneficial and very useful. And I'll give you just one example, and then I'll stop because I'm sure you'll have a few questions. But I'll give you just one example. As I mentioned, back in the spring, in March and April, with the outbreak of COVID, we added a health component to our risk nexus. And that allowed us to identify what we call COVID speed. It's a phrase I coined back now in April, March or April, I can't remember exactly when, but COVID speed. And I use that to explain the speed of the spread, the speed of the policy response, which if we can think back was unprecedented, made 2008, 2009 look like slow motion, the speed of the market response to the policy response, which was again unprecedented, the speed of science, which I think is absolutely critical, the capacity to get to a vaccine in less than a year, when it typically takes 10 years, and now speed of delivery in terms of the rolling out the vaccinations, which arguably has not been as fast as we would like it, but I think we're going to pick up that pace very, very quickly, particularly in the United States here in the next couple of weeks, the next couple of months. And now the most important point is I've taken this idea of COVID speed and said that COVID speed is breaking out beyond health to other key global issues like climate, like cyber, like genomics, like fintech and crypto. And this is my whole thrust towards thematic investing. I think we're in a completely different investment landscape. We're going much faster. It's like we were driving down the road at 55 miles an hour in a 55 mile an hour zone. And now we've just moved into a 65 mile an hour zone. We're not going back to 55 miles an hour. And so for investors, we have to start to think not only stocks versus bonds, Brazil versus the US, value versus growth, but we have to think about thematically. How do we position our portfolios to have exposure to climate change, to cyber, to fintech, things that are global, things that are happening at rapid speed and are upending and disrupting the traditional ways of thinking about things. This is where the alpha is going to come from, because we're moving into a different market regime as well. And it's really important for investors in Brazil, as we know very well, for years and years and years. You just had to sit in government bonds and get paid 6-7% real. And those days are gone. We know that in Brazil. In the United States, for the last 10 years, a straight 60-40 portfolio gave you a 10% per annum return. Just 60-40, 60% S&P, 40% Treasuries, done. Well, guess what? That's gone. Those days are over. Forward-looking 10-year returns on a 60-40 are dismal. So to me, we've been in a market environment where beta has been very generous. Just straight market return, very generous. We're no longer in that environment, and we need to find ways to generate alpha. And my view is that thematic investing, understanding that COVID speed, that model of abundant, low-cost financial capital plus global intellectual capital focused on a single issue leads to a completely new rate of change. And so for me, this is one of the reasons why I formed TPW Advisory, because I think we're in an unprecedented opportunity set for global macro thinkers to use thematic investing to add alpha to the traditional portfolio process.
No, that's great. And I remember well, what you said during our conference that, the 2021 onwards is going to be like, the best time, for asset allocation, because,
Yeah.
as you said before, you just didn't need to do it. And the start, and I think let's talk about what really drives markets and what everybody's talking about now, which is the US, 10-year, which had, a substantial. I mean, there was, you can kind of divide, the move before, the Senate election and after the Senate election, and I know you have, a very, out of consensus call of U.S. Treasury going to 2%, sometime at the end of this year. So, it's kind of a broad question, but how do you see that move, and how does that reconcile with your very bullish call on non-U.S. stocks and selected emerging markets, commodities, and the whole reflation trade?
Excellent. Yeah, no, that is a big question, or a couple of questions wrapped into one, Roberto, but you're absolutely right. Look, my 2021 Outlook piece was entitled "The Golden Age for Asset Allocation," right? So that is very much my thesis. And the thematic investing idea, or concept, structure is a part of that golden age of asset allocation. And it's very straightforward the way I approach things, I think. First off, I believe we're going to have a global economic boom in 2021 and 2022. We're going to see global growth rates that have not been seen in 50 years since the early 1970s. And so whatever model people are using, whatever experience people have, virtually no one in the markets today will have been investing the last time we had global growth this robust. So that's point one. When you think about and who you're going to listen to, who you're going to talk to, what models you're going to use, keep in mind that we're going into an unprecedented 50-year long period of global growth, or a period where global growth has not been this strong in 50 years. And I can get into the reasons why that growth will be so strong in a minute, if you like. That leads to the Great Rotation. And so I was using the term Great Rotation trade because I've been on this thesis for 5-6 months since late last summer, this idea of a rotation. And basically that rotation includes a bear market in US Treasuries, which we'll get to again in a second. And as well as a switch from US equity leadership, which has been the only game in town for a decade since the bottom in 2009. It's been a one-way trade, which was US equity and US tech. I think both of those are going to underperform as we go forward, and already are. I'll give you a quick illustration. Over the last 3 months, I just did this work yesterday, the day before. Over the last 3 months, S&P XLK, which is the ETF for big cap US tech, is up 6%. The S&P is up 8%. ACWI ex-US, so everything outside the US, is up 16%. So we are already in the early stages of a rotation away from the US, away from technology. I said, again, months and months ago, tech kryptonite was going to lead to tech underperformance. What is that kryptonite? It is a combination of vaccines, which kills the work from home trade, and rising rates, which means that the valuation case for big cap tech is much less appealing than it was when rates were falling, because of the valuation of the cash flows of big cap tech, which is now the big tech stocks are huge cash flow generating machines. So for that reason, that helps explain why XLK has been underperforming and will likely underperform. And if big cap tech underperforms, which is 35 to 40% of the S&P, then the S&P is going to underperform relative to markets that don't have that kind of tech, which is the non-US developed markets, which is where I am most constructive. And so the third phase, so global economic boom, great rotation, that great rotation leads to a golden age for asset allocation. And one of the big calls, one of the very big calls, and people are just making it today. JP Morgan just came out today to say underweight bonds, overweight commodities. If you've been following my work, you know I've been saying that for months and months. And I continue to say it because I think we're very early in what's likely to be a secular bull market for commodities. So if you have a global economic boom and you have unprecedented excess savings, estimated at 10 to 15% of global GDP, available for people to use once they feel comfortable going out and spending, which will happen as we vaccinate more people, which is, I think governments are going to get on top of this problem of vaccination very quickly, because they've seen in part what happened in the United States a week or so ago with the attack on the Capitol of the United States. When people are attacking capitals of countries, you can be assured of one thing, and that one thing is that governments are going to become activists, and they are going to spend money. And so when you have that money being spent, when you attack that vaccination problem, President Biden has said he wants to put in 100 million doses in the first 100 days. The estimate of what the US needs to achieve herd immunity by midsummer is 1.4 million doses or so a day. So I think in the next couple of months, we're going to be very close, and the markets will start to discount that herd immunity and that big spending, and what I think is going to be a big party. I mean, I know Brazil, it's the summertime there. Here in New York, it's the wintertime. So it's going to be like a big party on Ipanema, which I used to remember going to when I was doing my Brazil fund. Always like to go down on the weekends, go down on Friday night so I could have the weekend in Rio before doing business with BNDES on Monday morning. So many good stories and good memories of Brazil. But just to finish the point, all that spending, all that activity, and yet, the consensus for the 10-year Treasury at the end of 2021 is 1.2%. We're almost at 1.2% right now. But as I know you did, Roberto, and probably most people on the call, on the webinar, you know, we've all done looking at 5, 10, 15, 20 different outlooks for 2021. And the one thing that struck me, the biggest inconsistency with my point of view, was this idea that the 10-year was going to finish the year 2021 at 1.2%, maybe 1.3. People were being really aggressive if they said the 10-year would be 1.3, 1.4 at the end of the year. I wanted to make a point, and so I said I expect it to be between 1.75% and 2% by the end of the year, which was probably one of the most extreme forecasts out there. Why? It's simple. We're going to have a big spending boom. We're going to have the economy growing at 6, 7, 8% in nominal terms, 6% or so in real terms in the United States and globally. And I'm not alone in this thinking. Morgan Stanley, my old firm, has a global growth forecast for this year of 6.5%. So if we get there, we're going to have much higher interest rates. And I think Where the disconnect is that folks expect the Fed to kind of stomp on any backup in rates because they're afraid of what it will mean for the recovery. I think in this idea of tapering, that already within just, the 10-year went from 0.95 to 1.15, and people start talking about tapering. And you have Chair Powell having to come out and saying, oh, guys, you're way, way, way early. And I think to me, it's very simple. The Fed and the ECB, by the way, in Europe have said they want to let inflation run hot above target, the asymmetric inflation targeting, AIT, run hot for a period of time so that we can recalibrate a little bit. So I think the central banks have already told us what's going to happen. They're not going to stomp on long-term rates in a very sudden fashion. They are going to let rates rise. They are going to let that yield curve steepen. We're already right now, I think, at 3-year wides for the 10-year, 2-year spread in the United States. That's going to be great for financials. Financials are the single biggest sector in the value baskets in the United States. They're one of my favorite trades in Europe. I love the European financials. I called them a screaming buy on Bloomberg TV back in, I think, September, and the anchor almost laughed me out of the room, off the Zoom call because he thought it was just outrageous.
Yeah.
But I think I like financials, and so that's how that process is going to play out. We're going to get an inflation scare. Keep in mind that in March, April, and May of 2020, inflation was negative, minus 0.6, minus 0.8 for a couple of months. When those numbers fall out of the year-over-year calculation, the base number is going to go up dramatically. So, don't be surprised by that. Expect inflation, headline inflation in the US to be on a year-over-year basis over 2% in the next couple of months. Expect the 10-year to continue to back up. Don't expect the stock market to go down because of that. It is going to provide a headwind for technology. It does suggest that the US will underperform. It does mean that money will continue to flow to non-US markets. And it does suggest that the opportunity set is for global leadership to shift to non-US equities. And when these moves happen, they are not once a week, they're not moves for a month or 2 months. These are multi-year moves. The US has been by far the world's best performer for more than a decade. Before that, there was a 5-year period when non-US markets outperformed. I think we're going into a similar environment now, where for the next several years, while the tech valuation gets worked down, while the political structure in the US gets reformulated, while we have kind of a repricing of the American brand, which I think is very interesting. You have the political brand in the United States has probably never been cheaper, right? A recent poll said that 79% of Americans think the country is falling apart. 79%. You don't get much worse than that. And yet, U.S. financial assets on an absolute and relative basis are priced close to all-time highs. That dichotomy is really interesting to think about, how that's going to play out. You have financial assets all-time high, political brand pretty close to an all-time low. The capital hasn't been attacked in 150 years since the 1800s. So that's how that plays out is going to be really interesting. But to me, it all ties into U.S. relative underperformance, weighed down by technology. Non-tech, ex-U.S. outperforms, multi-year, people are underinvested, huge opportunity.
No, it's great, and you make a very interesting point on the U.S. brand. And you mentioned that poll in the U.S., but of course, before the capital events, I saw polls when people in Germany and some other European countries, they rate China more favorably than the U.S. I mean, it cannot get worse than this.
Yeah.
But let me just yeah, of course, and let me just summarize what you said. And so it looks like this combination of very low rates for very long times, at the short end, but the U.S. 10-year, pointing towards 2%, is very good. It bodes well, for your call of reflation, financials, and away from technology. Is it right, to say that the market has panicked and kind of brought forward this inflation debate, which was supposed to happen, let's say, at the end of 2021 or maybe even 2022, and because of the Senate victory with the Democrats, the market has is having that discussion too early. Is it right to say this? I mean,
yes, I think that is kind of correct. I mean, look, the Senate race was really important, as you point out, because it gave control to the Democrats, and it was a surprise. It was a very big surprise. I don't think a Democrat had won a runoff election in Georgia in decades and decades. So it was a big surprise. And markets, when you have a surprise, they react aggressively. Today's action was kind of different than that. For example, today a pretty big sell-off in the U.S. and in Brazil and elsewhere with after the Biden package discussion from last night. And that's more of a buy the rumor, sell the news type of market environment, which I think is fine. But once it became clear that the Democrats were going to control the Senate as well as the House and the presidency, then I think you had two things happen. One, it's pretty clear that you're going to get a more activist, progressive, Democratic administration. And keep in mind, and this is an important point, most of the people in the Biden administration on the economic policy side were part of the Obama team. And they know that they went too small in 2008 and 2009. And they're not going to make that same mistake twice. In part because of the political environment in the U.S., whether it's the attack on the Capitol or whether it's the Black Lives Matter protests in the summer, there's a lot of anger and frustration in the United States body politic. And President Biden understands the need and the opportunity to use this activist, policy-driven government, as I mentioned earlier. This is what I'm talking about. You have we've had in the United States governments that basically haven't done much at the federal level for years and years because we've had gridlock between the two parties and nothing can get done. And I do believe that the combination of taking control of the Senate with the help of the vice president vote, as well as the infighting that's going to occur within the Republican Party as a result of the activities of the last couple of weeks, means the possibility of a more aggressive, activist, progressive policy structure by the Biden administration that can perhaps get a couple of Republican votes and surprise people to the upside in terms of what's going to happen in addressing inequality and addressing climate. And I think that's the constructive case. And that's what surprised people. And that's why the Treasury sold off a little bit. But look, I would argue that the Treasuries under 1% were mispriced. I don't think the surprise was that we moved from 0.95 to 1.15 in 2 or 3 weeks. I think the surprise is that why did it take, why was it at 0.95 to begin with? If you're thinking forward and if you understand what's likely to be happening, we should have already been over 1%. I think it shows the strength of the mindset that the Fed will not allow rates to go higher. But once that mindset kind of breaks, then the market tests, right? And you're going to see the market testing and the 10-year backing up, in my view, for the next couple of months and the next couple of quarters. And I think just one more point on this, I think it's really important to think about the integration of fiscal stimulus and climate change, because this is what drives this idea of COVID speed going into climate. You have the same global focus. You have a existential issue. You have 60% of the world's GDP has committed to a net zero target by 2050. And I think everyone should be spending some time understanding what getting to net zero by 2050 is going to require, and then positioning part of their portfolio accordingly. I'll give you one illustration. In the United States, for President Biden to meet a net zero target, or to put us on the path of that target, requires electric vehicle sales, think Tesla, to go from 2% of sales to 50% of sales by 2030, in the next 10 years. 2% to 50%. Think about charging stations. Think about all the infrastructure that has to go. Think about copper, what goes into electric vehicles. I mean, this is the way to be thinking about the next couple of years from an investing perspective. We are having a ton of money, activist governments who are going to spend that money. We've broken this idea that fiscal policy is bad, that debt is bad. And so we're going to have the money, we have the issue, we have the talent, and another illustration, I looked just the data point the other day, global venture capital. VC money raised and invested in climate tech has tripled over the last 4 years. Okay, it's gone up threefold over the last 4 years. But guess what? It's only 5% of the total VC money invested. So we are in early days in this process, early days. And that's why you see things like Tesla going up 800%. It's kind of a land grab, and it's a lack of investment opportunities, lack of vehicles, which is why you see the whole SPAC phenomenon in the United States, right? These blank check companies coming public left, right, and center, bringing public and integrating with electric vehicle manufacturers. Why? Because the market is saying, give me more. I need more exposure to electric vehicles. And guess what? There are ETFs with one instrument. This is why I love the ETF space and have focused on it very intently over the last couple of years. You can buy electric vehicles on a global basis with one ETF. And that's virtually unprecedented. And so that's this idea of activist governments, big money, climate focus, participate in that. And so it's almost like thinking ESG. Here's another example, and then I'll stop. ESGU is the big ESG ETF in the United States. It was number 5 last year in taking in new money. The fifth biggest inflow of any ETF in the United States. Number 5, ESGU. Guess what? ESGU going forward is not going to be the way to play, because it has a regular tech weight in it. And that was a great tailwind in 2020 and 2019. It's going to be a headwind in 2021. And so ESGU is generation 1, first generation. Second generation is ICLN or QCLN, which are the clean energy ETFs. That's the second generation. So a more targeted approach to the idea of climate change and climate adjustment.
No, it's great. And I agree, and I think you've said this before, that, on January 21st, we're going to have the race to zero starting. So, there'll be let's say a healthy competition for, which countries, will do better on this, really existential threat. And it would be great if, as you say, we have the same, COVID speed as we had in research for the vaccine. So just finish a little bit on health and science. So does the fact that, most of European countries are adopting tighter restrictions, and, it's a surprise to everyone what's happening in Germany. So the market is relatively sanguine about this in the sense that, maybe the market is thinking, okay, if life does not go back to normal in April, it's going to be May. If not May, it's going to be June, and so forth. So is that the right way to think?
I certainly think so. Just looking at the performance over that last 3 months The VGK, which is the ETF I like for Europe, it includes the UK, which I think is pretty interesting now that Brexit has finally taken place, is up about 15% over that last 3 months versus the S&P up 8%, so almost a double versus the S&P. So Europe has done reasonably well. I think it's early days yet. I'm probably one of the most bullish people you'll find on Europe, though again, I would say that I think I saw today on Bloomberg that both Morgan Stanley and JP Morgan increased their view of European equities. Again, thank you very much. Help push up the holdings a little bit more. But I'm probably one of the most bullish people that you'll find on Europe. And I believe Europe has a very real chance to win the decade of the 2020s. So and this is where the tripolar world kind of comes into play. So I look at Asia and I see China clearly leading the process in Asia. Asian integration deepening rapidly with their recent trade agreement being a prime example of that. And Asia is going to be the consuming center of the global economy over the next 10 to 20 years. Look at any long-term study about consumption growth, and it's very Asian-centric. Europe, on the other hand, is seeking to be kind of the regulatory power, or what I call, or what political scientists call, the normative power, the rules-making power. And Europe is setting the rules in technology. And you just look at what's happened in the US with banning of different people from various platforms. It's not a free speech issue at all. It's a simple matter of not inciting violence on platforms that prevent and prohibit people from inciting violence on their platforms. It's really that simple. But Europe is ahead of us in that process with their digital market and digital service acts. Europe is trying to set the stage regulatory-wise for tech and for climate. And in the midst of this, Europe has done 3 things in the last 6 months. They have agreed to a 7-year budget. They have agreed to a joint recovery fund, which significant amounts of money to be let out over the next several years. And they are tying that to the Green Deal and financing it through joint issuance of debt. And that last bit is very, very important, because up until this point, there has been huge resistance within Europe to joint issuance, because joint issuance means we've got to come up with joint money to pay down the debt at some point when it becomes due. And so I think what you're going to see is deeper European integration as they start to tax technology, digital tax, carbon tax, and start to integrate their budget, their recovery fund, and their climate issue all together in one, financed jointly, setting the stage for joint taxation, setting the stage, therefore, for common deposit insurance, which in turn sets the stage for cross-border bank M&A. Yeah. And that is what is coming down the road. And you already see the players like Deutsche Bank CEO. If you pay attention to this stuff, if you have the framework, then when you see different bits and pieces, that sets the picture for you. And so it was not a surprise to me to hear 2 weeks ago, Deutsche's CEO saying they want to be part of the acquiring class of banks, not being acquired. And so you're already seeing now not cross-border, but single country M&A within the countries, in Italy, in Spain, and elsewhere. You're seeing bank mergers because they have to get to a reasonable size. Next, in the next couple of years, you're going to see cross-border bank M&A. And it makes perfect sense because these banks are trading dirt cheap. Price to book is about 0.5 for the European financials, even after the move that they've had. So so I think Europe, to finish the point, I'm very, very bullish on a long-term outlook, the medium-term outlook for the next couple of years in Europe. I think they have a chance to win the 2020s. People hate Europe. Nobody thinks it can do anything right. I think they're making great strides. And so when I look at the tripolar world, I see the Asian consumption story, I see the European regulatory story and integration story, joint issuance, and I look at the US and the Americas, and that's where I struggle to see what the story is. I really struggle to see what the case is. And if you look at the last couple of months, the last couple of years in the United States, and even integration south of the border or north of the border, it's very difficult to see how the Americas come together to compete with a European mindset that is becoming increasingly. Brexit was a big eye-opener, and Brexit led the rest of the Europeans to say, hey, we've got to get tighter. And the Asians are already there. So the Americans and the Brazilians as well, you know, Argentines, Chileans, Peruvians, etc. What is the rationale for our hemisphere? And I'm hopeful that in the next 2 to 4 to 6 years, if I'm right in thinking that the Democratic Party probably has a runway to win in 2022 and 2024, that you will get to something that the strategic thinking of the United States will start to shift in other countries to understanding the need for deeper integration. So instead of saying, let's pull all our companies out of China and put them back in the United States, which is not going to happen. And if they do come back, it's going to be all robots, not going to be people doing the jobs. Let's take some of that and reshore or nearshore some of that production in Asia, bring it back to the hemisphere of the Americas, and nearshore it to Mexico, to Central America, to South America, and deepen our own integration so that we can compete in what I believe is a tripolar world between Asia, Europe, and the Americas.
Oh, that's great, Jay. And I want to go back to what you said on Europe, and I agree. And I tell Europeans that sometimes, you know, they complain a lot and they are way too skeptical, you know, given, you know, what they have here. But with respect to climate, you know, I think, you know, that view is already, you know, established, and looking at the ESG taxonomy, and it's all coming from Europe. On tech, you know, two questions. I mean, do they really have the power to rein in, U.S. tech? And how much of, one of the things we've said about the Biden administration is that, you know, he would rebuild the ties with Europe, you know, which have been on a 60-year low. And how much does that mean for, let's say, a global tax deal, and let's say a digital tax, and it also has implications for climate change? So I guess the question is, do you think the market is underestimating the impact of the U.S. and Europe, working together again on these, two very important issues?
Great question, Roberto. And to kind of get to the first part, look, why Europe is going to have the opportunity to play that regulator role is kind of for two reasons. The first is Europe combined is about 500 million people. It's a big market. It's a 17, $18 trillion GDP market. It's almost the same size as the United States in terms of GDP. All right, so that's one. Two, they don't have their own champions. They don't have their own Tencent, Alibaba, Apple, Facebook, Amazon, etc. So it's the only part of the world, really, I mean, outside of like Africa and the Middle East, that has that combination of heft, eyeballs, market size, and lack of homegrown competitors. I mean, look at, for example, as a contrast, what's going on in India, right? And the fight over technology company access to the Indian market. They're busy tossing out Chinese apps and pushing off Walmart and others in the United States. Why? Because they want to have it for themselves. Of course they do. Who wouldn't? But Europe, for whatever reason, has not developed its tech champions. I mean, there are a few SAP and a few others, Spotify and things like this that are kind of interesting, but they're not platform companies like the Chinese and the Americans. So both have to fight in Europe. They want access to that market share. And then to get access, the Europeans are being very smart in saying, well, if you want access to our market, here are the rules you have to play by. And if you don't want to play, I don't care. It's not a European company that's getting hurt. So they can be the rule setter. That's one. And the second point, in terms of the US-European relations, I think it's really important to look at the recent European and Chinese investment deal that was agreed just a couple weeks ago. And some people think right in the face of the incoming Biden administration. And I don't think it was necessarily meant in that way. I do think it was a sense by the Europeans that in the trade negotiations that the US has had with China for the last couple of years, President Trump's phase one deal, the US was able to get some access to the Chinese market that the Europeans did not have. And so the Europeans saw this new deal as a way to level the field with the Americans in China. The Chinese wanted to do the deal to get more access to the European market, particularly, interestingly enough, in clean energy and renewables. That was a big part of what China wanted to do, because they knows there are going to be tremendous contracts on renewable clean energy in Europe over the next 5 years or so. So that's why the deal was done in the time frame it was done, because it made sense for both sides to do it now. I do think it suggests, and again, my tripolar world thinking, it does suggest that there is the mindset in Europe, post-Brexit and post-President Trump, that Europe needs to develop its own kind of strategic autonomy and develop its thinking as its own standalone region. That fits perfectly with my tripolar world thesis. And as I said, much of what I see and have seen over the last couple of years supports this idea of a tripolar world, supports the idea of regional integration being the driver. All the tech stuff, all this banning of people definitely supports the idea of splinternet, for example, and the idea that there's going to be separate tech stacks for China and for the US. How Europe plays out remains to be seen. But we have done nothing in the United States over the last several years but to tell the Chinese that they must establish their own tech self-sufficiency throughout the tech stack. We're telling them they must, because we're cutting them off from our own stuff. So what do we think is going to happen in a couple of years? In a couple of years, there's not going to be any tech business for American companies in China. Why we would want to do that is a very open question, makes very little sense to me, but that's what we've done. And so I do think the actions of the last couple of years have deepened this idea of regional integration everywhere but except the Americas, as I mentioned earlier, and makes it, to me, if we have 4 more years of gridlock in the United States, I would think that our geopolitical position in the world would be very, very damaged, because the Chinese and Asians and the Europeans, as I think I've hopefully made clear, are moving very, very fast. And if we don't move fast in this hemisphere, then we are going to lose relative positioning and relative power.
No, that's a great point. And I have my own thesis why Europe does not have their own tech giants. It's simply because if you look at the 2 largest industrial powers in Europe, which are Germany and Italy, not France, they have lost the war. They have a ton of U.S. bases, so they have no military budget, and you cannot separate technology from the military budget. So that's the story of Silicon Valley. Everybody knows, the People's Liberation Army, the stakes they have in the Chinese tech companies, and that's the case with Israel. So, it's not something that Europeans have to punish themselves for. It's simply simply history. And it's going to be very interesting to see how that plays out now. I mean, on Splinternet, and how would they stand between U.S. and China. But just on that, I mean, are you a believer in the Eurasia integration? I've met investors who look at that as a theme. So the whole integration from the south of China, Hong Kong, Shenzhen, where they have the factories, up to to Rotterdam, and of course, the Belt and Road has a role to play in this. I mean, are you a believer in that strategy, or on that thesis going forward?
No, I like your thoughts about the military, Roberto. That makes a lot of sense, because you're absolutely right. Big spending, government spending on the military side, or the research side, has been very important for U.S. Technology development. And you don't hear quite as much about that in China. I think probably in part because they don't want to talk about that. But clearly you have a big role, obviously, with government itself. Maybe not through the military, through the PLA, but just in general. As far as Eurasia is concerned, I'm not a believer. That's kind of counter to my thesis of separate regions, Europe being its own region. Eurasia is the argument that those two really kind of come together as one. And you can make kind of a topographical argument for that, I guess, but I'm more of a skeptic about the integration in that fashion. I do think that, look, the people say, well, where's Africa? Where's the Middle East? And my answer has always been, well, when those regions become integrated sufficiently amongst themselves, they can become, there's nothing that says it can only be 3 poles or 3 regions. It can be 4, but they're not there yet at the moment. And I kind of think the same way about Eurasia. You can argue, based on rail traffic and at least the ability to now, put something on a train in China and have it go all the way across and end up, as you say, in Amsterdam or in Holland or Germany or somewhere. Yes, and maybe that becomes part of a logistical network. But I don't think you're going to see a integration the way I talk about it, with politics and economics and policy the same way as I'm seeing it develop in Europe now, and in Asia as well. And so I don't share the Eurasian thesis, though I respect it and I pay attention to it, and it's something that is interesting to certainly contemplate.
That's great. And I mean, we have like, say, 6-7 minutes to wrap up. I'd like to ask to revisit what you said about a month ago, well, exactly a month ago, on our conference and in your main calls, and to say if anything has changed given what has happened in the last month. We have seen that most of the calls have worked, so far so good. But what did not work, if any, and which calls have become stronger? I mean, has there been any fact, maybe the Democratic Senate win, anything has made your calls stronger and more compelling?
Yeah, no, that's a great way to wrap up, Roberto. Perfect. Yes, you're right. Things have worked out very, very well. The last couple of months were very powerful. I do have the audited performance for the base global multi-asset portfolio. I'll just share it with your audience. Pretty proud of it, actually. It was up 19% gross last year in US dollars for a 50% ACWI, 40% global government bonds, and 10% commodity portfolio, which the index itself was up I believe less than 9%. So very, very strong performance, mostly coming from November and December. Those months were spectacular for the rotation thesis. And so, no, I've really not changed much. The focus of my activity in the last 2 months has been very much making space for those thematic investments that I told you about at the beginning of our discussion. That to me is really the key to have. The question is, how much should investors have of those themes, both in each theme and then collectively as kind of a thematic, either a thematic sleeve on a traditional portfolio, or increasingly I'm thinking about a specific portfolio construction of themes, so that you take those, what I call the big five of climate, cyber, genomic, robotics, fintech, and crypto, and allocate accordingly within them. You can almost do that easily with ETFs. So that when in terms of like what I've been doing, that's basically been what I've been doing, because I've had to find cash for those positions, and that cash had to come out of existing positions, which in essence came out of some of the very aggressive moves we've seen in some of the cyclical components of the portfolio, like energy, for example. Both clean and old style energy were up 40% in those 3 months I just mentioned. ICLN and XLE were both up over 40% since November. So taking some money off the top of those has been part of the process, obviously. Reallocating that into some of these other themes has been part of the process. Adding a component of Bitcoin to the portfolios has been part of the process. I believe that is something that is becoming an institutional investable asset, and is something investors should really consider carefully and pay attention to, and then size properly, which is the big question. But so for me, no, still overweight equities, dramatically underweight bonds, have no U.S. Treasury exposure whatsoever, significantly overweight commodities of all stripes, so industrial metals, energy, precious metals, ag, the whole space. We're in the very early stages of a secular move in commodities that is going to be exacerbated by significant supply-demand imbalances in the next couple of years that cannot be dealt with quickly. When you have to bring more mines on stream, it's not a 3-month process, as you know very well. So overweight non-US versus the US, like Europe and Japan in particular. Equal weight, roughly, emerging markets, like the Asian tech stack, the whole semiconductor chain. Semiconductors today in shortage. You're having auto plants shut down around the world because they can't get enough chips. Perfect example of what I mean with the supply-demand imbalance. Look at what's happened to SMH as an example. So like the China, Taiwan, Korea exposure, and also Latin America, both Brazil and Mexico through ILF, commodity, cheap value opportunities, and then the cyclical and value. So underweight tech, except in emerging markets. I like EM tech. Underweight US big cap tech. Think not FANGs, think things like Tesla. Think disruption and innovation, not domination. And then in fixed income, I would also mention I like real estate. There's a tremendous need for yield. I believe the thesis that the office is dead is going to be dead wrong. So I like real estate plays. I'd also just point out in the energy space that you can buy MLPs in the United States with a 9% yield, where the underlying companies are buying back stock, and XLE itself, the big energy ETF, has a 5% yield on it. So stocks are dividend plays in certain aspects, and I think that's important to keep in mind. So the positions are the same. I think we're early in the process. I think days like today, where you have a pretty aggressive pullback. I know much of the clean energy space in the US was down 5% today after being up 40% in 3 months. Perfectly healthy, perfectly appropriate, which is why I think you top slice a little bit when you have these big moves. You take some money off the table, reposition it into other things. And as I said, for me, that's been making sure that that thematic part of the portfolio is robust enough to make a difference, because that's where I believe the alpha is going to come from. It's not going to come from straight beta, particularly not in the United States. But I also think European government debt is unappealing. I do like emerging market debt, particularly dollar debt. I'm not a big bear on the dollar. Struggle to really see it going down dramatically against, for example, the euro or the yen. I do like the Chinese currency. Just make a point on that. I think that the strengthening renminbi is very bullish for China. It's something they want because it helps facilitate their dual circulation strategy of driving internal consumption. It helps the rest of Asia because it provides an umbrella for the rest of Asia to compete under China if China's the price setter. And then it's bullish for the rest of the world because an appreciating renminbi is inflationary. A depreciating renminbi is deflationary. And so we want inflation, not deflation. So stronger renminbi, very bullish. And I think that sets the stage for the beginning of regional FX blocks. So the Asian region is going to increasingly circle around the renminbi. Europe, obviously, the euro is already done. And in the Americas, we have the dollar. But to me, it's another example of how the tripolar world is starting to manifest itself. And so I think that covers equities and some of the underlying bits, cover fixed income, like credit, not sovereign, like preferreds, like real estate, commodities, bullish, full stop, alternatives, Bitcoin, a believer and a participant. And I think the thematic approach is where investors are going to be able to add alpha in the next 12 to 24 to 36 months.
That's great, Jay. Fantastic. It was great to have you here. Great discussion. And, just reminding everyone that this is going to be a bi-weekly series. It's going to be on a Monday. We're still going to, decide on the time, whatever works best, for our clients and, of course, for Jay. So we're going to be communicating that with you. Again, thanks very much for your audience. It was great, from the numbers I hear. And again, thanks, Jay. Congratulations on TPW Advisory, and congratulations on the great calls you've had. And I'm sure it's going to be a great 2021. So I want to wish everyone a great weekend. Same to you, Jay. I've had very busy last few days, and look forward to see you in the next session.
Yes, Roberto. Thanks again. Congrats on all your success at OhmResearch. It's great to be tied back into Brazil, one of my favorite countries, and look forward to working with you and making this, as you say, a regular bi-weekly event. And hopefully we can get some Q&A and get some fun back and forth. I know Brazilian investors are extremely astute and financially aware. Always like that about the folks I talk to down there. And so I'm here in New York. If you're coming through New York, feel free to reach out. And TPW Advisory is open for business and would love your business. Thanks, Roberto. Take care.